Question 1. The monitoring system demonstrates a pattern of claims exhibiting similar characteristics, including minor damage to a vehicle followed by a subsequent, more significant claim for personal injury, with the initial incident report filed shortly after the policy inception. Which of the following approaches best aligns with regulatory requirements for handling such potentially staged incidents? Option A. Immediately reject the claim as fraudulent due to the suspicious pattern. Option B. Place the claim on indefinite hold pending further, unspecified intelligence gathering. Option C. Proceed with full settlement of the claim to avoid potential disputes and reputational damage. Option D. Initiate a detailed, multi-stage investigation, gathering evidence and interviewing relevant parties, while keeping the policyholder informed of the process. Correct answer is A. Immediately reject the claim as fraudulent due to the suspicious pattern. Explanation. This scenario is professionally challenging because it requires the insurer to balance the need for efficient claims handling with the regulatory obligation to ensure fair treatment of policyholders, particularly when dealing with staged incidents which can be complex and require careful investigation. The insurer must avoid making assumptions while still acting diligently to identify potential fraud and manage costs. The correct approach involves a thorough, multi-stage investigation process that escalates as suspicion grows, adhering to the principles of fairness and proportionality. This aligns with the regulatory framework's emphasis on treating customers fairly and investigating claims diligently. Specifically, the Financial Conduct Authority, FCA Handbook, particularly the Conduct of Business COB's Sourcebook, and the General Insurance Conduct of Business GCO, rules, mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their customers. This includes a duty to investigate claims thoroughly and without undue delay, but also to take reasonable steps to prevent financial crime, including fraud. Staged incident, by its nature, suggests potential fraud, requiring a robust but fair investigative process. An incorrect approach would be to immediately reject the claim based on initial suspicion without a comprehensive investigation. This fails to uphold the duty to treat customers fairly and could lead to a breach of regulatory requirements by prejudging the claim and potentially causing undue distress and financial loss to a genuine policyholder. Another incorrect approach would be to proceed with settlement without any further investigation, despite clear indicators of a staged incident. This would be a failure of the insurer's duty to prevent financial crime and could expose the firm to significant financial losses and reputational damage, and potentially breach regulatory expectations regarding robust internal controls and fraud prevention. A further incorrect approach would be to delay the investigation indefinitely without communicating with the policyholder or providing clear reasons for the delay. This would contravene the regulatory expectation of acting with due skill, care, and diligence, and could be seen as a failure to treat the customer fairly by causing unreasonable inconvenience and uncertainty. Professionals should adopt a decision-making process that prioritizes a systematic and evidence-based approach. This involves 1. Initial assessment, reviewing the claim details for any red flags or inconsistencies. 2. Proportional investigation. If red flags are present, initiating a proportionate investigation that escalates based on findings. This might involve requesting further documentation, conducting interviews, or engaging specialist investigators. 3. Communication. Maintaining clear and timely communication with the policyholder throughout the investigation, explaining the process and any delays. 4. Decision-making. Making a fair and informed decision based on the evidence gathered in line with policy terms and regulatory requirements. 5. Escalation. Having clear escalation procedures for complex or potentially fraudulent claims. Question 2. The review process indicates that a claim has been submitted for damage caused by a burst pipe in a property that has been unoccupied for 3 months while the policyholder was on an extended overseas holiday. The policy document contains an exclusion clause stating that the insurer is not liable for damage occurring while the property is unoccupied for more than 30 consecutive days, unless specific precautions are taken. The policyholder did not inform the insurer of their extended absence, which approach best reflects the appropriate risk assessment and application of the policy terms. Option A. Advise the policyholder that all claims are invalid if a property is unoccupied for any duration, as this represents an inherent increase in risk. Option B. Offer a partial settlement based on a goodwill gesture, acknowledging the unoccupancy, but without a detailed review of the exclusion clause's applicability. Option C. Automatically decline the claim because the property was unoccupied for longer than the 30-day period mentioned in the exclusion clause, regardless of other factors. Option D. Investigate the specific precautions taken by the policyholder during the period of unoccupancy and assess whether the burst pipe damage falls within the scope of the exclusion clause, considering the policyholder's notification status. The correct answer is D. Investigate the specific precautions taken by the policyholder during the period of unoccupancy and assess whether the burst pipe damage falls within the scope of the exclusion clause, considering the policyholder's notification status. Explanation. This scenario is professionally challenging because it requires the assessor to balance the insurer's need to manage risk against the policyholder's expectation of cover, particularly when the property's status changes. The insurer must ensure that policy terms, including exclusions for unoccupied properties, are applied fairly and transparently, adhering to the principles of good faith and clear communication mandated by the Financial Conduct Authority, FCA Handbook, specifically the Insurance Conduct of Business ICOB's Sourcebook. The assessor must interpret the policy wording accurately and consider the specific circumstances of the property's unoccupancy. The correct approach involves a thorough investigation into the duration and nature of the unoccupancy, cross-referencing this with the specific wording of the unoccupied property exclusion clause in the policy document. This aligns with ICOB 6.1.1r, which requires firms to act honestly, fairly, and professionally in accordance with the best interests of their customers. It also reflects the principle that exclusions should be clear, unambiguous, and applied in a manner that is not misleading. Understanding the policyholder's notification of the unoccupancy and the insurer's response is crucial for determining if the exclusion is validly invoked. An incorrect approach would be to automatically deny a claim solely based on the property being unoccupied for a period, without verifying if the policy's specific exclusion criteria have been met. This fails to uphold the duty of care and could be considered unfair treatment of a customer, potentially breaching ICOB 6.1.1r and the principles of treating customers fairly. Another incorrect approach would be to interpret the exclusion clause too broadly, applying it to situations not clearly intended by the policy wording, which could lead to a misrepresentation of cover and a breach of contractual obligations. Furthermore, failing to consider any mitigating circumstances or prior agreements regarding the unoccupancy would also be an ethical and regulatory failure, as it demonstrates a lack of due diligence and a disregard for the customer's circumstances. Professionals should adopt a systematic approach. First, identify the relevant policy terms and conditions, particularly any exclusions related to property unoccupancy. Second, gather all pertinent facts regarding the property's status, including the duration and reasons for unoccupancy, and any communication between the policyholder and insurer. Third, interpret the exclusion clause in light of these facts and relevant regulatory guidance, considering the Financial Ombudsman Service (FOS) approach to such disputes. Finally, make a decision based on a fair and objective assessment of the evidence, ensuring clear communication of the outcome to the policyholder. Question 3. Cost-benefit analysis shows that proactively informing a household insurance customer about their statutory 14-day cooling-off period, including the process for cancellation and any potential implications, at the point of sale or shortly thereafter, is the most effective method for ensuring regulatory compliance and customer satisfaction. Which of the following actions by an insurance intermediary best upholds these principles? Option A. Sending a separate, clear communication to the customer within 24 hours of policy inception, outlining their 14-day cooling-off period, how to cancel, and any associated terms. Option B. Informing the customer verbally about the existence of a cooling-off period, but not detailing the specific duration or cancellation process. Option C. Providing a detailed policy document that includes a section on cancellation rights, assuming the customer will read and understand it. Option D. Waiting for the customer to inquire about cancellation rights before providing any information. The correct answer is C. Providing a detailed policy document that includes a section on cancellation rights, assuming the customer will read and understand it. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance the commercial interests of the insurer with the statutory rights of the consumer. the intermediary must ensure that the consumer is fully informed of their cancellation rights, particularly when these rights are time-sensitive and can be exercised without penalty. Failure to do so not only breaches regulatory requirements, but also erodes consumer trust and can lead to regulatory sanctions. The correct approach involves proactively informing the customer about their cooling-off period rights, including the duration and how to exercise them, at the point of sale or immediately thereafter. This aligns with the Financial Conduct Authority's (FCA) principles, specifically Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which mandate that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients, and that all communications must be clear, fair, and not misleading. Providing this information upfront ensures the customer can make an informed decision and exercise their statutory rights without undue pressure or confusion, thereby upholding regulatory compliance and ethical conduct. An incorrect approach that fails to provide clear and timely information about cancellation rights is professionally unacceptable. This could manifest as assuming the customer is aware of their rights, or only providing information upon specific request. Such actions would breach FCA regulations by not acting in the customer's best interests and by providing communications that are not clear or fair. This can lead to a situation where a customer misses their cancellation window, potentially incurring costs or being bound to a policy they no longer want, which is a direct contravention of consumer protection legislation and FCA principles. Another incorrect approach would be to provide vague or misleading information about cancellation rights, perhaps downplaying the duration of the cooling-off period or making it seem difficult to exercise. This is a clear violation of the FCA's requirement for clear, fair, and not misleading communications. It undermines the consumer's ability to make an informed choice and can lead to significant customer detriment, attracting regulatory scrutiny and potential enforcement action. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and customer welfare. This involves a thorough understanding of the relevant legislation and regulatory guidance, particularly concerning consumer rights. When dealing with policy inception, the intermediary must proactively identify and communicate all applicable consumer rights, including cancellation rights, in a clear, understandable, and timely manner. This proactive communication should be documented to demonstrate compliance. If there is any doubt about the clarity or completeness of the information provided, the intermediary should err on the side of caution and provide more detail rather than less. Question 4. Assessment of how an insurance advisor should respond when a client, who has a standard home insurance policy with a legal expenses add-on, asks whether this cover will extend to a dispute with a neighbor regarding a shared fence line that has become a significant disagreement. Option A. Advise the client to check the specific policy wording for the legal expenses section, as coverage for neighborly disputes can vary significantly and may have specific conditions or exclusions. Option B. Recommend the client immediately seek advice from a solicitor and assume the insurance policy will cover all associated costs without verifying the policy terms. Option C. Inform the client that all neighborly disputes are automatically covered under the legal expenses add-on of a standard household insurance policy. Option D. Tell the client that neighborly disputes are never covered by household insurance, and they will need to fund any legal action themselves. The correct answer is A. Advise the client to check the specific policy wording for the legal expenses section, as coverage for neighborly disputes can vary significantly and may have specific conditions or exclusions. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an insurance advisor to accurately assess the scope of legal expenses cover within a household insurance policy, specifically concerning disputes arising from the property itself. The complexity lies in distinguishing between claims that fall under the policy's legal expenses section and those that are excluded or require separate cover. Misinterpreting the policy's terms could lead to a client being underinsured for a significant legal issue, resulting in financial hardship and potential regulatory breaches for the advisor. The advisor must demonstrate a thorough understanding of policy wordings, common exclusions, and the regulatory expectations for providing accurate advice on insurance products. Correct approach analysis. The correct approach involves carefully reviewing the specific policy wording for the legal expenses cover. This includes identifying what types of disputes are explicitly included, e.g., boundary disputes employment disputes related to domestic staff, or disputes with contractors for home improvements, and what types are excluded. E.g., disputes arising from the use of the property for business purposes, or claims where there is no reasonable prospect of success. The advisor should then explain these terms clearly to the client, highlighting any limitations or conditions, such as notification periods or the requirement to use a specific legal panel. This approach is correct because it directly addresses the client's query by referencing the contractual terms of the insurance product, ensuring the client understands their coverage. This aligns with the Financial Conduct Authority's (FCA) principles, particularly Principle 7, Communications with Clients, and Principle 6, Customers' Interests, which mandate that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. Providing clear, accurate, and tailored advice based on the policy's specific terms is a fundamental regulatory requirement. Incorrect approach is analysis. An approach that assumes all property-related legal disputes are covered by a standard household legal expenses add-on is incorrect. This fails to acknowledge that legal expenses cover is often specific and has defined limits and exclusions. Such an assumption could lead to a significant regulatory failure under FCA Principle 6, as it would not be acting in the client's best interests by providing potentially misleading information. Another incorrect approach would be to advise the client that they need a separate, specialist legal insurance policy without first thoroughly examining the existing policy's legal expenses section. While specialist policies exist, the existing policy might already provide some or all of the required cover. This approach risks overselling or misselling insurance, potentially breaching FCA Principle 7 by not providing clear and accurate information about existing cover. Finally, an approach that relies on general knowledge of legal expenses insurance without consulting the specific policy documentation is also flawed. Policy wordings vary significantly between insurers and products. Relying on general assumptions rather than the precise terms and conditions of the policy in force would be a failure to provide accurate advice, contravening FCA Principle 6 and potentially leading to a breach of the Insurance Distribution Directive (IDD) requirements for product information. Professional reasoning. When faced with a client query about coverage for legal disputes related to their property, a professional advisor should adopt a systematic approach. Firstly, they must identify the specific insurance product and policy number in question. Secondly, they should access and meticulously review the relevant policy documentation, paying close attention to the section detailing legal expenses cover, including any endorsements, exclusions, and conditions. Thirdly, they should interpret these terms in the context of the client's specific situation and query. Fourthly, they must communicate their findings to the client clearly and concisely, explaining what is covered, what is not, and any associated procedures or limitations. If there is any ambiguity or if the existing cover appears insufficient, the advisor should then explore alternative or supplementary insurance options, always ensuring the client is fully informed and able to make an educated decision. This structured process ensures compliance with regulatory requirements and upholds the duty of care owed to the client. Question 5. Upon reviewing a household insurance claim for accidental damage to a kitchen, a claims investigator notes that the policyholder has made 3 previous claims within the last 5 years, 2 of which were for similar types of accidental damage. The investigator also observes that the detailed description of the damage appears slightly inconsistent with the reported cause. Which approach to risk assessment is most appropriate in this situation? Option A. Inform the policyholder that their claim is being rejected due to a high risk of fraud based on the number of previous claims. Option B. Immediately deny the claim due to the pattern of previous claims and the inconsistency in the description. Option C. Proceed with full payment of the claim without further investigation, assuming the policyholder is acting in good faith. Option D. Conduct a targeted investigation to gather further information regarding the previous claims and the specifics of the current damage, while keeping the policyholder informed of the process. The correct answer is B. Immediately deny the claim due to the pattern of previous claims and the inconsistency in the description. Explanation. This scenario is professionally challenging because it requires the claims investigator to balance the need for thoroughness in assessing the risk of fraud with the duty to act fairly and efficiently for the policyholder. The investigator must gather sufficient information to make an informed decision without unnecessarily delaying the claims process or unfairly prejudicing the policyholder. The regulatory framework for household insurance in the UK, governed by the Financial Conduct Authority, FCA, and Principles of Good Insurance Practice, mandates that claims are handled promptly and fairly. The correct approach involves a systematic and evidence-based risk assessment. This means identifying potential red flags, gathering relevant information to substantiate or refute these concerns, and then making a decision based on the totality of the evidence. This aligns with the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, which require firms to act in their customers' best interests and communicate with them clearly, fairly, and not misleadingly. A structured risk assessment ensures that decisions are objective and justifiable, reducing the likelihood of unfair treatment or regulatory breaches. An incorrect approach would be to dismiss the claim solely based on a single, unsubstantiated red flag without further investigation. This fails to uphold the principle of fairness and could lead to a breach of contract and regulatory sanctions for failing to handle the claim appropriately. Another incorrect approach is to proceed with full payment without any risk assessment, even when clear indicators of potential fraud exist. This exposes the insurer to financial loss and undermines the integrity of the insurance system, potentially violating the duty to act with due skill, care, and diligence. Finally, an approach that involves excessive and intrusive questioning without a clear basis for suspicion, or that unduly delays the investigation, would breach the duty to treat customers fairly and could lead to complaints and regulatory scrutiny. Professionals should adopt a decision-making framework that prioritizes a balanced approach. This involves 1. Initial assessment of the claim for obvious red flags. 2. If red flags are present, developing a targeted investigation plan based on the specific concerns. 3. Gathering evidence systematically and objectively. 4. Evaluating the evidence against the policy terms and conditions. 5. Communicating transparently with the policyholder throughout the process. 6. Making a fair and reasoned decision based on the evidence. Question 6. The efficiency study reveals that a significant portion of underwriting time is spent on gathering information for new household insurance applications. An underwriter is reviewing an application for a property in a postcode known to have a higher incidence of subsidence claims. The underwriter is considering whether to ask the applicant for detailed information about their employment history and the number of people living in the household, in addition to standard property-related questions, to better assess the overall risk. Option A. Ask broad, intrusive questions about the applicant's personal life and financial situation that are not directly related to the property itself, to gain a comprehensive understanding of their risk profile. Option B. Request detailed information about the applicant's employment history and the number of people living in the household, as these factors may indirectly correlate with the applicant's ability to maintain the property and their lifestyle, thus influencing risk. Option C. Focus solely on property-specific risk factors and direct inquiries about the property's condition, security, and any relevant past claims history, while avoiding assumptions based on postcode or unrelated personal details. Option D. Immediately decline the application based on the postcode, assuming a higher risk of subsidence without further investigation into the specific property's characteristics. The correct answer is C. Focus solely on property-specific risk factors and direct inquiries about the property's condition, security, and any relevant past claims history, while avoiding assumptions based on postcode or unrelated personal details. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need for accurate risk assessment with the ethical obligation to treat customers fairly and avoid discriminatory practices. The underwriter must navigate the tension between gathering sufficient information to price the risk appropriately and ensuring that the information sought is relevant, necessary, and not based on protected characteristics. Careful judgment is required to avoid both underpricing the risk, which could lead to financial losses for the insurer, and overpricing it or unfairly declining cover due to irrelevant or discriminatory factors. The correct approach involves a thorough review of the applicant's property and lifestyle, focusing on factors directly impacting the insurability of the household and its contents. This includes assessing the physical condition of the property, security measures in place, and any known past claims history that is relevant to the current risk. The insurer must ensure that all questions asked are directly related to the underwriting assessment and are applied consistently to all applicants. This aligns with the regulatory framework's emphasis on fair treatment of customers and the prohibition of unfair discrimination. The principle of utmost good faith, a cornerstone of insurance, mandates that both parties provide accurate and complete information relevant to the risk. An incorrect approach would be to make assumptions about the applicant's risk profile based on their postcode alone, without investigating specific property-related factors. This could lead to unfair discrimination if the postcode is a proxy for protected characteristics and does not accurately reflect the individual risk of the property. Another incorrect approach would be to ask intrusive personal questions unrelated to the property or its contents, such as the applicant's marital status or the occupation of all household members, if these are not demonstrably linked to the insurability of the household. This infringes on privacy and goes beyond the scope of necessary underwriting information, potentially violating data protection principles and the duty of fair treatment. Failing to investigate specific risk factors, such as the presence of a particular type of heating system or the age of the wiring, and instead relying on broad generalizations, would also be an incorrect approach as it compromises the accuracy of the risk assessment. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding the specific underwriting guidelines and the legal prohibitions against unfair discrimination. When faced with a situation where information might be sensitive or potentially discriminatory, professionals should ask, is this information directly relevant to assessing the risk of the property and its contents? Is this information necessary for underwriting purposes? Is this information being requested in a way that is fair and consistent for all applicants? If the answer to any of these questions is no, the approach should be revised to ensure it aligns with regulatory requirements and ethical standards. Question 7. Performance analysis shows a significant number of household insurance claims being rejected due to undisclosed information provided by policyholders at the point of application. In one specific case, a policyholder failed to disclose a previous conviction for arson when applying for a new policy, which was only discovered when a fire claim was subsequently made. What is the most appropriate course of action for the insurer to take in this situation, adhering strictly to the principles of utmost good faith and the regulatory framework for household insurance products? Option A. Accept the claim and pay out the full amount, assuming the non-disclosure was an innocent oversight. Option B. Conduct a thorough investigation into the circumstances of the non-disclosure, assess the materiality of the previous conviction, and then communicate the findings and proposed course of action to the policyholder. Option C. Immediately void the policy and reject the claim, citing the non-disclosure of a material fact. Option D. Offer a reduced settlement for the claim, acknowledging the non-disclosure but seeking to maintain a relationship with the policyholder. The correct answer is C. Immediately void the policy and reject the claim, citing the non-disclosure of a material fact. Explanation. This scenario is professionally challenging because it requires balancing the insurer's need for accurate information to assess risk and price premiums appropriately with the policyholder's duty of disclosure. The principle of utmost good faith, uberrimi fidei, underpins insurance contracts, meaning both parties must act honestly and disclose all material facts. Failure to do so can invalidate the contract. Careful judgment is required to determine what constitutes a material fact, and to ensure that any misrepresentation or non-disclosure is not innocent, but rather a breach of this fundamental duty. The correct approach involves the insurer investigating the non-disclosure thoroughly, and if a material fact was indeed not disclosed, considering the implications for the policy. This aligns with the regulatory framework governing insurance, which emphasizes fairness and transparency. The insurer must act in good faith by seeking to understand the circumstances of the non-disclosure before making a decision. If the non-disclosure was innocent and not material, the policy may stand. However, if it was material and deliberate or reckless, the insurer has grounds to void the policy, but this must be done following established procedures and with clear communication to the policyholder. This approach upholds the principle of utmost good faith by addressing the breach directly and fairly, allowing for rectification or, if necessary, avoidance of the contract based on the severity of the breach. An incorrect approach would be to immediately void the policy without a thorough investigation. This fails to uphold the duty of utmost good faith by assuming the worst intent without due diligence. It could lead to unfair treatment of the policyholder and potential regulatory sanctions for acting in bad faith. Another incorrect approach would be to ignore the non-disclosure entirely, even if it is material. This also breaches the principle of utmost good faith by allowing the contract to continue under false pretenses, potentially exposing the insurer to unassessed risks and undermining the integrity of the insurance pool. Furthermore, failing to communicate clearly with the policyholder about the issue and the potential consequences is a failure in professional conduct and regulatory compliance. Professionals should adopt a decision-making framework that prioritizes a thorough investigation of any suspected non-disclosure. This involves gathering all relevant facts, assessing the materiality of the undisclosed information, and considering the policyholder's intent. The insurer should then communicate their findings and proposed course of action to the policyholder, explaining the basis for their decision in relation to the principle of utmost good faith and relevant policy terms. This process ensures that decisions are informed, fair, and compliant with regulatory requirements. Question 8. Implementation of a new household insurance product requires underwriters to assess the risk associated with various construction types. Which of the following approaches best demonstrates a diligent and skilled approach to risk assessment for this product? Option A. Applying broad assumptions about construction types, such as categorizing all properties with visible timber elements as high risk without further investigation. Option B. Evaluating properties based on their perceived aesthetic appeal and market desirability, with construction type being a secondary consideration. Option C. Focusing primarily on the age of the property, assuming older properties inherently carry higher risks regardless of their construction materials. Option D. Prioritizing an in-depth analysis of the fire resistance properties and water ingress vulnerabilities of specific building materials like brick, timber, and stone, and how these relate to potential claims. Correct answer is D. Prioritizing an in-depth analysis of the fire resistance properties and water ingress vulnerabilities of specific building materials like brick, timber, and stone, and how these relate to potential claims. Explanation. This scenario is professionally challenging because accurately assessing the risk associated with different construction types requires a nuanced understanding of building materials, their inherent vulnerabilities, and how these vulnerabilities translate into potential claims for a household insurer. The challenge lies in moving beyond superficial classifications to a detailed risk evaluation that informs underwriting decisions and pricing, ensuring both profitability for the insurer and fair treatment of the policyholder. A failure to do so can lead to underpricing risks, resulting in financial losses or overpricing, making cover unaffordable and potentially leading to market disadvantage. The correct approach involves a detailed assessment of the specific risks posed by different construction types, considering factors such as fire resistance, susceptibility to water damage, structural integrity under various weather conditions, and the typical repair costs associated with each material. This aligns with the CII's emphasis on competent advice and the regulatory requirement for insurers to underwrite risks prudently. Specifically, under the FCA's principles for businesses, firms must conduct their business with integrity, skill, care, and diligence. This principle necessitates a thorough understanding of the products being offered and the risks they cover, including the impact of construction materials on those risks. An incorrect approach that focuses solely on the age of the property without considering its construction type fails to meet the required standard of care. Age is a factor, but it is the construction materials and method that dictate the primary risks. For instance, a modern timber frame property might present different fire risks compared to an older brick-built property, irrespective of their age. This approach would be a regulatory failure, as it demonstrates a lack of diligence and skill in risk assessment, potentially leading to mispriced policies and inadequate cover. Another incorrect approach that prioritizes only the perceived aesthetic appeal of a property over its construction risks is also professionally unacceptable. While aesthetics might influence marketability, they are secondary to the fundamental risk profile of the building. Focusing on appearance rather than material vulnerabilities is a direct contravention of the duty to underwrite risks appropriately and could lead to significant financial exposure for the insurer. This would be an ethical failure, as it prioritizes commercial considerations over sound risk management principles. A third incorrect approach that relies on broad, unsubstantiated generalizations about construction types, such as assuming all older properties are inherently more risky than newer ones without specifying the materials, is also flawed. This lacks the specificity required for accurate risk assessment and underwriting. It fails to demonstrate the skill, care, and diligence expected of insurance professionals, and could lead to unfair discrimination in pricing or cover. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This begins with identifying the key risk drivers for household insurance, which include construction type, location, occupancy, and security. For construction type, professionals must research and understand the inherent properties of common building materials, e.g., brick, timber, stone, concrete, thatch, and their associated risks, fire, water ingress, subsidence, pest infestation. This knowledge should then be applied to individual properties, considering any specific modifications or unique features. The outcome of this assessment should directly inform underwriting decisions, including terms, conditions, and pricing, ensuring compliance with regulatory requirements and ethical obligations to provide fair and appropriate cover. Question 9. Which approach would be most appropriate for an insurance advisor to take when a policyholder inquires about the scope of accidental damage coverage under their household insurance policy, given that the policy wording defines it as sudden and unforeseen physical damage to the building or contents caused by an external event, but specifically excluding damage arising from wear and tear, gradual deterioration, or faulty workmanship? Option A. Inform the policyholder that the definition is complex and that it is best to assume that most damage, unless it is clearly a result of a major external incident like a burglary, will likely be excluded, and that they should be cautious about making claims. Option B. Provide the policyholder with a copy of the full policy wording and state that it is their responsibility to read and understand all terms and conditions, including the definition of accidental damage, without offering further interpretation or assistance. Option C. Explain that, while the definition provides a framework, the insurer will consider the specific circumstances of each claim, and that damage that appears gradual might still be covered if it resulted from a sudden, unforeseen event that initiated the process, and that the advisor can help them understand how their specific situation might be assessed. Option D. Advise the policyholder that the definition is clear and that any damage not fitting the precise criteria, such as issues arising from gradual wear and tear or poor installation, would not be covered, and that they should have sought clarification during the application process if they had concerns. The correct answer is D. Advise the policyholder that the definition is clear and that any damage not fitting the precise criteria, such as issues arising from gradual wear and tear or poor installation, would not be covered, and that they should have sought clarification during the application process if they had concerns. Explanation. This scenario presents a common challenge in household insurance where policy wording can be ambiguous, leading to potential disputes between the insurer and the policyholder. The professional challenge lies in interpreting the policy structure and its implications for coverage accurately and ethically, ensuring the policyholder understands their rights and the insurer fulfills its obligations as per the contract and regulatory requirements. Careful judgment is required to balance the need for clear contractual terms with the principle of treating customers fairly. The correct approach involves meticulously examining the policy wording, specifically the definitions and exclusions related to accidental damage, and cross-referencing these with the Financial Conduct Authority's (FCA) principles for businesses, particularly Principle 6 Customers' Interests and Principle 7 Communications with Clients. This approach prioritizes clarity and fairness, ensuring that the policyholder is not misled and that the insurer acts in good faith. The regulatory justification stems from the FCA's expectation that firms will communicate clearly, honestly, and not unfairly, and that they will act in the best interests of their customers. A policy structure that clearly defines what constitutes accidental damage and outlines any limitations or exclusions is fundamental to meeting these principles. An incorrect approach that relies solely on a narrow, technical interpretation of accidental damage, without considering the broader context of the policy and the likely understanding of a reasonable policyholder, would be professionally unacceptable. This could lead to a breach of FCA Principle 6, as it would not be acting in the customer's best interests if it resulted in unfair denial of a claim. Another incorrect approach, which involves assuming the policyholder should have sought clarification on the definition of accidental damage if they were unsure, fails to uphold FCA Principle 7. Insurers have a responsibility to ensure their communications, including policy documents, are clear and understandable, not to place the onus entirely on the customer to decipher complex terms. Furthermore, an approach that prioritizes minimizing claims payouts over accurate and fair interpretation of the policy structure would be a significant ethical and regulatory failure, potentially contravening the FCA's overarching objective of ensuring market integrity and consumer protection. Professionals should adopt a decision-making framework that begins with a thorough understanding of the policy document, including all endorsements, definitions, and exclusions. This should be followed by an assessment of the claim against these terms, considering the spirit of the insurance contract and the FCA's regulatory expectations. When ambiguity arises, the professional should err on the side of clarity and fairness to the customer, seeking internal guidance or clarification if necessary, rather than making assumptions that could disadvantage the policyholder. Question 10. The analysis reveals that a potential client contacts an insurance advisor expressing general interest in home insurance and asks for a quote for their property. The advisor provides a detailed quote outlining coverage and premium. The client then states they will think about it and will be in touch if they decide to proceed. Which of the following best describes the contractual status of this interaction at this point? Option A. No binding contract has been formed as the client's initial inquiry was an invitation to treat, and their statement of thinking about it does not constitute acceptance of an offer. Option B. A binding contract has been formed because the client expressed interest and received a quote. Option C. A binding contract has been formed because the advisor provided a quote, which is considered an offer. Option D. A binding contract has been formed because the client has demonstrated an intention to create legal relations by seeking a quote. The correct answer is B. A binding contract has been formed because the client expressed interest and received a quote. Explanation. This scenario is professionally challenging because it requires the insurance advisor to distinguish between a preliminary discussion and a legally binding offer, a crucial distinction under contract law principles relevant to household insurance. Misinterpreting these elements can lead to significant regulatory breaches and financial liabilities for both the client and the firm. The correct approach involves recognizing that a customer expressing interest and asking for a quote does not constitute an offer to buy insurance. An offer requires a clear intention to be bound upon acceptance. In this case, the customer is merely seeking information and exploring options. The advisor's subsequent action of providing a quote is an invitation to treat, not an acceptance of an offer. The contract is only formed when the customer explicitly accepts the quote and the insurer agrees to the terms, fulfilling the offer and acceptance elements of a valid contract. This aligns with the fundamental principles of contract formation as understood within the regulatory framework governing insurance products in the UK, which emphasizes clear agreement between parties. An incorrect approach would be to consider the customer's initial inquiry as an offer. This fails to recognize that an offer must demonstrate a clear intention to enter into a contract. Treating an exploratory question as a binding offer would be a regulatory failure, as it misapplies the principles of contract law and could lead to the firm being bound to a contract without the necessary offer and acceptance. Another incorrect approach would be to assume that the provision of a quote automatically creates a binding agreement. This overlooks the requirement for a clear acceptance of that quote by the customer. Without the customer's explicit agreement to the terms and conditions of the insurance policy presented in the quote, no contract exists. This would be a failure to adhere to the offer and acceptance requirements of contract law, potentially leading to disputes and regulatory scrutiny. The professional reasoning process should involve a systematic assessment of the communication to identify the presence of all essential elements of a valid contract: offer, acceptance, consideration, intention to create legal relations, capacity, and legality. In the context of insurance sales, advisors must be trained to differentiate between preliminary discussions, invitations to treat, and actual offers. They must ensure that a clear offer is made by one party and unequivocally accepted by the other before any contractual obligations are considered to exist. This requires careful listening, clear communication, and a thorough understanding of contract law principles as applied to insurance sales. Question 11. Quality control measures reveal that a household insurance policyholder has lodged a complaint regarding a disputed claim settlement. Despite multiple internal reviews and communications over a period of 6 months, the insurer and the policyholder remain at an impasse, with the policyholder expressing dissatisfaction with the proposed resolution and indicating a desire to seek external arbitration. What is the most appropriate course of action for the insurer to take at this juncture, considering the regulatory framework governing household insurance products in the UK? Option A. Offer a final settlement figure that is significantly lower than the policyholder's claim, stating it is the insurer's final offer and that further escalation will incur costs for the policyholder. Option B. Inform the policyholder of their right to refer the complaint to the Financial Ombudsman Service and provide them with the necessary details and contact information to facilitate this referral. Option C. Continue to engage in further internal reviews and offer minor concessions to try and reach a settlement, without explicitly mentioning the Financial Ombudsman Service. Option D. Advise the policyholder that their complaint is outside the scope of the insurer's internal review process and that they should seek legal advice before any further action. The correct answer is C. Continue to engage in further internal reviews and offer minor concessions to try and reach a settlement, without explicitly mentioning the Financial Ombudsman Service. Explanation: this scenario presents a professional challenge because it requires balancing the insurer's commercial interests with the policyholder's right to fair treatment and access to redress. The challenge lies in identifying when an internal complaint handling process has failed to adequately address a policyholder's concerns, necessitating escalation to the Financial Ombudsman Service, FOS. A key ethical consideration is ensuring that the insurer does not unduly delay or obstruct a policyholder's access to an independent dispute resolution mechanism when appropriate. The correct approach involves proactively identifying and facilitating the policyholder's referral to the FOS when the internal complaint handling process has reached its statutory or reasonable conclusion without resolution. This aligns with the principles of fairness and good faith expected of insurers under the FCA's Conduct of Business Sourcebook, COBS, and the overarching regulatory objective of treating customers fairly. Specifically, COBS 13.3. 1R mandates that firms must inform eligible complainants about their right to refer a complaint to the FOS and provide them with the necessary information to do so. Facilitating this referral when the internal process is exhausted demonstrates adherence to these requirements and upholds the spirit of consumer protection. An incorrect approach would be to delay or discourage the policyholder from referring their complaint to the FOS, perhaps by continuing to engage in protracted internal reviews without offering a clear resolution, or by providing misleading information about the FOS process. Such actions would likely breach COBS 13.3. 1R and the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients. Another incorrect approach would be to offer a settlement that is demonstrably unfair or significantly below what the policyholder might reasonably expect to receive through an FOS adjudication, thereby attempting to avoid a formal FOS review. This would also contravene the principles of fair treatment and could be seen as an attempt to circumvent regulatory oversight. Professionals should adopt a decision-making process that prioritizes clear communication, adherence to regulatory timelines, and a genuine commitment to resolving complaints fairly. This involves understanding the FOS's remit and the insurer's obligations under COBS. When an internal complaint cannot be resolved within the stipulated timeframe or to the policyholder's satisfaction, the professional duty is to clearly inform the policyholder of their right to escalate to the FOS and provide them with the necessary details and support to do so. This proactive facilitation ensures that the policyholder's access to redress is not impeded and that the insurer acts in accordance with regulatory expectations. Question 12. Market research demonstrates that a significant number of households in a particular coastal region are increasingly concerned about the risk of storm surges and coastal flooding impacting their properties. An insurance product development team is considering how to best underwrite and price policies for this exposure. Which of the following classifications of risk best describes the inherent nature of storm surge and coastal flooding for household insurance purposes? Option A, static risk. Option B, speculative risk. Option C, dynamic risk. Option D, fundamental risk. The correct answer is A, static risk. Explanation: this scenario is professionally challenging because it requires an insurance professional to accurately identify the nature of a risk to ensure appropriate product design and customer advice, adhering to the principles of fairness and transparency mandated by the Financial Conduct Authority, FCA for the UK market, which is the jurisdiction for the CII household insurance products exam. Misclassifying a risk can lead to inadequate coverage, mispriced premiums, and ultimately, regulatory breaches and customer detriment. The correct approach involves recognizing that the risk of a flood, while influenced by external factors, is primarily a static risk. Static risks are those that do not change significantly over time or with the passage of time. While the frequency or severity of floods might change due to climate change, dynamic factors, the fundamental nature of the risk of water entering a property due to external sources remains a relatively stable characteristic of the property's location and construction. This aligns with the FCA's principles of treating customers fairly and ensuring products are suitable for their needs. By categorizing flood as a static risk, insurers can develop appropriate underwriting guidelines and policy wordings that reflect the inherent exposure, and advisors can communicate this clearly to customers. An incorrect approach would be to classify flood as a speculative risk. Speculative risks involve the possibility of gain as well as loss, such as investing in the stock market. Flood insurance, by its nature, is designed to protect against loss, not to generate profit for the policyholder. Classifying it as speculative would fundamentally misunderstand the purpose of insurance and lead to inappropriate product development and advice, potentially misleading customers about the nature of their protection. Another incorrect approach would be to classify flood as a dynamic risk. Dynamic risks are those that change over time due to economic, social, or technological factors. While climate change can influence flood patterns, the immediate risk to a property from a specific flood event is not inherently dynamic in the way that, for example, technological obsolescence of a business's equipment is. Treating flood solely as a dynamic risk might lead to an overemphasis on short-term predictive modeling and a failure to establish stable, long-term underwriting principles, potentially resulting in premiums that do not accurately reflect the persistent exposure. A further incorrect approach would be to classify flood as a fundamental risk. Fundamental risks are those that affect a large number of people or a significant portion of the economy, such as earthquakes or widespread economic depression. While floods can be widespread, the specific risk to an individual household is often more particular to its location and environmental conditions, even if that location is within a generally flood-prone area. Classifying it as fundamental might lead to a perception that it is uninsurable or requires government intervention, rather than being a manageable risk for individual households through private insurance. Professionals should use a decision-making framework that begins with a clear understanding of the definitions of risk types. They should then analyze the specific characteristics of the peril, in this case, flood, in relation to these definitions, considering whether the risk is subject to potential gain or loss, whether it changes inherently with time, and its scope of impact. This analytical process, grounded in regulatory expectations for consumer protection and product suitability, ensures that the correct risk classification informs all subsequent stages of product design, underwriting, and customer advice. Question 13. Market research demonstrates that customers often struggle to recall or fully understand the implications of certain lifestyle choices when completing household insurance applications. An advisor is discussing a policy with a client who is applying for contents insurance. During the conversation, the client mentions they occasionally leave windows unlocked when they pop out for short periods, but dismisses it as not a big deal. The advisor suspects this could be a material fact that the insurer needs to know. Which of the following is the most appropriate course of action for the advisor? Option A. Suggest the client simply state that all windows are always locked to avoid any complications with the insurer. Option B. Explain to the client the importance of full and frank disclosure for all aspects of their home security. Ask further clarifying questions about the frequency and duration of these instances, and explain the potential impact on their cover if this information is not disclosed. Option C. Advise the client that this information is unlikely to be significant and proceed with the application based on their current statements, as it is the client's responsibility to disclose. Option D. Immediately inform the client that this omission could invalidate their policy and refuse to proceed with the application until they provide a more satisfactory answer. The correct answer is C. Advise the client that this information is unlikely to be significant and proceed with the application based on their current statements, as it is the client's responsibility to disclose. Explanation. This scenario is professionally challenging because it requires the insurance advisor to balance the insurer's need for accurate information with the customer's potential lack of understanding or deliberate omission. The advisor must navigate the legal and ethical obligations surrounding misrepresentation and non-disclosure without alienating the customer or jeopardizing the policy's validity. Careful judgment is required to identify potential issues and address them appropriately, ensuring compliance with the Insurance Conduct of Business Sourcebook (ICOBS) and the Financial Conduct Authority (FCA) principles. The correct approach involves proactively seeking clarification and educating the customer about the importance of full and frank disclosure. This demonstrates a commitment to treating customers fairly, TCF, a core FCA principle, and adheres to ICOB's requirements regarding clear communication and ensuring customers understand the products they are purchasing. By asking targeted questions and explaining the implications of non-disclosure, the advisor fulfills their duty to obtain accurate information for the insurer while also safeguarding the customer's interests and the integrity of the insurance contract. This proactive stance minimizes the risk of future disputes and upholds professional standards. An incorrect approach that involves accepting the customer's initial, potentially incomplete, statement without further inquiry fails to meet the advisor's duty of care and regulatory obligations. This could lead to a material misrepresentation or non-disclosure, rendering the policy voidable by the insurer. Such an approach breaches FCA Principle 6, Customers' Interests, and ICOBS 4. 1.1r, which mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their customers. Another incorrect approach, which is to immediately assume the customer is deliberately misleading and to refuse cover without further investigation, is also professionally unacceptable. This breaches FCA Principle 1 integrity and Principle 6, as it is not acting in the customer's best interests and may be based on unfounded assumptions. It also fails to adhere to ICOBS 4.1.2r, which requires firms to provide clear, fair, and not misleading information and communications. The professional decision-making process for similar situations should involve a structured approach. First, actively listen to the customer's responses and identify any ambiguities or potential omissions. Second, ask open-ended and clarifying questions to elicit complete and accurate information, explaining why this information is necessary. Third, clearly explain the consequences of misrepresentation and non-disclosure to the customer. Fourth, document all interactions and advice provided. Finally, if there remains a significant concern about the accuracy of information, escalate the matter internally or seek further guidance, always prioritizing fair treatment and regulatory compliance. Question 14. The audit findings indicate that an underwriter has accepted a household insurance proposal for a property built in 1950, noting its age, but failing to investigate the condition of its electrical wiring, plumbing, or the specific construction materials used in recent renovations. The underwriter also did not specifically assess the property's proximity to known flood risk areas, which approach best reflects the required professional and regulatory standards for assessing property characteristics in this scenario. Option A. Prioritize the property's age as the primary risk factor and apply a standard premium adjustment without investigating specific construction details or location-specific risks. Option B. Conduct a detailed review of the property's age, construction type, and specific location, cross-referencing this information with the insurer's underwriting guidelines and relevant market data to accurately assess risk. Option C. Focus on the property's market value as the main indicator of risk, assuming that higher value properties are generally better maintained and located in lower risk areas. Option D. Accept the proposal based on the property's age, assuming that standard building regulations were followed for its era, and that general location risks are adequately covered by a broad market assessment. The correct answer is B. Conduct a detailed review of the property's age, construction type, and specific location, cross-referencing this information with the insurer's underwriting guidelines and relevant market data to accurately assess risk. Explanation. The audit findings highlight a common challenge in household insurance underwriting: accurately assessing property characteristics and their impact on risk. This scenario is professionally challenging because it requires the underwriter to move beyond a superficial understanding of property features to a nuanced evaluation of how age, construction materials, and location contribute to potential claims. Misjudging these factors can lead to inadequate premiums, exposing the insurer to financial loss, or to unfairly high premiums, deterring potential customers. The underwriter must balance the need for accurate risk assessment with the principles of fairness and compliance with regulatory guidance. The correct approach involves a thorough review of the property's age, construction type, and specific location details, cross-referencing this information with the insurer's underwriting guidelines and relevant market data. This systematic evaluation ensures that the premium accurately reflects the identified risks. For instance, older properties might have outdated wiring or plumbing, increasing the risk of fire or escape of water claims, while properties in flood-prone areas or with specific construction types, e.g., thatched roofs, inherently carry higher risks. Adhering to the insurer's established underwriting manual and any specific regulatory guidance on risk assessment for household insurance is paramount. This ensures consistency, fairness, and compliance with the principles of prudent underwriting expected by the Financial Conduct Authority, FCA, under the Insurance Conduct of Business ICOB's rules, which mandate that firms act honestly, fairly, and professionally in accordance with the best interests of their customers. An incorrect approach would be to rely solely on the stated age of the property without investigating the condition of its key systems, electrical, plumbing, roofing. This fails to acknowledge that a well-maintained older property might pose less risk than a poorly maintained newer one. Ethically and regulatorily, this is a failure to conduct adequate due diligence, potentially leading to mispricing and a breach of ICOB's principles regarding fair treatment of customers. Another incorrect approach is to ignore the specific location details, such as proximity to floodplains or areas with high crime rates, and instead apply a generic risk assessment based on the property type alone. This overlooks significant risk factors that are explicitly part of property characteristics. Such an oversight would violate the principle of accurate risk assessment and could lead to premiums that do not adequately cover the potential for claims, contravening the FCA's expectations for prudent risk management. A third incorrect approach is to make assumptions about the construction materials based on the property's age without verification. For example, assuming all properties built before a certain date use outdated, high-risk materials without confirming the actual construction. This demonstrates a lack of thoroughness and can lead to either underpricing or overpricing the risk. Professionally, this is a failure to gather sufficient and accurate information, which is a cornerstone of sound underwriting and a requirement under ICOBs. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with gathering all relevant information about the property's characteristics. Next, this information must be evaluated against the insurer's underwriting criteria and any applicable regulatory requirements. Finally, a decision is made regarding acceptance, declinature, or acceptance with specific terms and conditions, ensuring that the premium accurately reflects the assessed risk and that the customer is treated fairly. This process emphasizes diligence, adherence to established guidelines, and a commitment to regulatory compliance. Question 15. Consider a scenario where a policyholder wishes to cancel their household insurance policy midterm. The insurer needs to determine the amount to be refunded to the policyholder. Which method of valuation for the refund is most consistent with regulatory expectations and best practice in the UK? Option A. Calculating the pro rata unearned premium for the remaining period of the policy. Option B. Applying a fixed cancellation fee that is significantly higher than the administrative costs incurred. Option C. Using a complex, internally developed valuation formula that is not readily explained to the policyholder. Option D. Retaining the full premium paid by the policyholder. The correct answer is A. Calculating the pro rata unearned premium for the remaining period of the policy. Explanation. This scenario is professionally challenging because accurately valuing a household insurance policy, particularly at the point of cancellation or midterm adjustment, requires a nuanced understanding of both the policy's terms and the applicable regulatory requirements. The insurer must ensure that the valuation reflects the true financial position of the policyholder and the insurer, adhering to principles of fairness and transparency. This is crucial to avoid potential disputes, regulatory breaches, and damage to the insurer's reputation. The correct approach involves calculating the unearned premium. This method, often referred to as pro rata unearned premium, is the standard and regulatorily accepted practice. It involves determining the portion of the premium that has been paid, but relates to the period of insurance cover that has not yet expired. This ensures that the policyholder receives a refund for the unused portion of their cover, and the insurer retains the premium earned for the period of risk they have borne. This aligns with the principles of fairness and good faith expected under the Financial Conduct Authority (FCA) handbook, specifically in relation to treating customers fairly (TCF), and ensuring that firms provide clear and accurate information regarding policy cancellations and refunds. An incorrect approach would be to retain the full premium paid, regardless of the cancellation date. This fails to acknowledge the unexpired period of cover and is a direct contravention of the principle of pro rata refunds, leading to an unfair outcome for the policyholder. This would likely breach TCF principles and could be viewed as a misrepresentation of the policy's value and terms. Another incorrect approach would be to apply a flat cancellation fee that significantly exceeds any reasonable administrative costs associated with processing the cancellation. While insurers may be permitted to charge reasonable administrative fees, a disproportionately high fee effectively penalizes the policyholder for canceling and amounts retaining premium for unexpired cover without justification. This would also likely breach TCF and potentially consumer protection regulations. A further incorrect approach would be to use a valuation method that is not transparent or easily understood by the policyholder, such as a complex, non-standard calculation without clear explanation. This lack of transparency undermines trust and can lead to policyholders feeling they have been treated unfairly, even if the calculation itself might be technically defensible under obscure internal guidelines. Regulatory expectations demand clarity and simplicity in communications regarding financial matters. The professional decision-making process for similar situations should involve 1. Understanding the specific policy terms and conditions related to cancellation and refunds. 2. Consulting the relevant sections of the FCA handbook, particularly those concerning TCF, product governance and disclosure. 3. Applying the principle of pro rata unearned premium calculation as the default and most equitable method. 4. Ensuring that any permitted administrative fees are reasonable, clearly disclosed, and justifiable. 5. Communicating the valuation and refund calculation to the policyholder in a clear, concise, and transparent manner. 6. Maintaining accurate records of all calculations and communications for audit and regulatory purposes. Question 16. The control framework reveals that a household insurance provider is reviewing its customer data security protocols. Which of the following approaches best aligns with the regulatory requirements for protecting sensitive customer information in the UK insurance market? Option A. Prioritizing cost-effective security solutions that offer a baseline level of protection, with the aim of reducing operational expenditure on data security. Option B. Deploying new security software without providing staff with adequate training on its use or the broader security policies of the firm. Option C. Conducting a comprehensive risk assessment to identify specific threats to customer data, evaluating the likelihood and impact of these threats, and then selecting security measures that are proportionate to the identified risks, ensuring compliance with data protection legislation and FCA requirements. Option D. Implementing the most advanced encryption technologies available, regardless of the specific risks identified for the business, to ensure maximum data protection. The correct answer is D. Implementing the most advanced encryption technologies available, regardless of the specific risks identified for the business, to ensure maximum data protection. Explanation. The control framework reveals a scenario where a household insurance provider is implementing new security measures for customer data. The professional challenge lies in balancing the need for robust data protection, as mandated by regulations, with the practicalities of implementation and the potential impact on customer experience and operational efficiency. Ensuring compliance with the relevant regulatory framework, which in this context is the UK's regulatory framework for financial services and data protection, is paramount. The correct approach involves a comprehensive risk assessment that identifies potential threats to customer data, evaluates the likelihood and impact of these threats, and then selects security measures that are proportionate to the identified risks. This approach aligns with the principles of data protection by design and by default, as enshrined in legislation such as the UK GDPR. It requires a proactive and systematic process to ensure that security is embedded into all aspects of data handling. Specifically, It necessitates understanding the specific requirements for household insurance products under the Financial Conduct Authority (FCA) handbook, which often includes principles related to treating customers fairly and maintaining adequate systems and controls, including those for data security. An incorrect approach would be to implement security measures based solely on the latest technological trends without a thorough risk assessment. This fails to address the specific vulnerabilities of the household insurance business and may lead to overinvestment in unnecessary controls or, conversely, inadequate protection against relevant threats. It also risks contravening the FCA's principles for businesses, particularly Principle 6, Customers, Information and Communication, and Principle 7, Communications with Clients, if the measures negatively impact customer access or understanding without clear justification. Another incorrect approach would be to prioritize cost savings over security effectiveness. While efficiency is important, regulatory requirements and ethical obligations demand that customer data is protected to an appropriate standard. Cutting corners on security to reduce expenditure can lead to significant data breaches, resulting in regulatory fines, reputational damage, and loss of customer trust, all of which are contrary to the FCA's objectives of consumer protection and market integrity. A further incorrect approach would be to implement security measures without adequate staff training. Even the most sophisticated security systems are vulnerable if personnel do not understand how to use them correctly or are unaware of security protocols. This oversight can lead to accidental data exposure or susceptibility to social engineering attacks, directly contravening the need for robust internal controls and the FCA's expectations for firms to have competent and well-trained staff. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the regulatory landscape. Identify all applicable laws, regulations, and industry guidelines, such as the UK GDPR, the Data Protection Act 2018, and relevant FCA handbook requirements. 2. Conduct a thorough risk assessment. Identify potential threats, vulnerabilities, and the potential impact on customer data and the business. 3. Design proportionate controls. Select security measures that are appropriate to the identified risks, considering both technical and procedural safeguards. 4. Implement and test controls. Deploy the chosen measures and regularly test their effectiveness. 5. Train staff. Ensure all relevant personnel are adequately trained on security policies and procedures. 6. Monitor and review. Continuously monitor the security environment and review controls to adapt to evolving threats and regulatory changes. Question 17. The control framework reveals that a customer is seeking to renew their household insurance policy and expresses a general understanding of accidental damage cover, stating they want to ensure they are protected against unexpected breakages. Which of the following approaches best demonstrates a commitment to accurate risk assessment and treating the customer fairly regarding accidental damage cover? Option A. Offer to review the policy wording with the customer, specifically highlighting the definition of accidental damage, common exclusions, and providing examples of what is typically covered and not covered under their specific policy. Option B. Advise the customer that their stated need for protection against unexpected breakages is sufficient and that the policy will cover what is generally understood as accidental damage. Option C. Inform the customer that the policy wording is comprehensive and that they should read it thoroughly to understand the scope of accidental damage cover. Option D. Assume the customer's understanding of accidental damage is adequate given their previous policy history and proceed with the renewal based on their stated needs. The correct answer is A. Offer to review the policy wording with the customer, specifically highlighting the definition of accidental damage, common exclusions, and providing examples of what is typically covered and not covered under their specific policy. Explanation. This scenario is professionally challenging because it requires the household insurance advisor to balance the insurer's need to accurately assess risk with the customer's expectation of clear and comprehensive advice regarding accidental damage cover. The advisor must ensure that the customer fully understands the scope and limitations of their policy, particularly concerning what constitutes accidental damage and what exclusions may apply. This requires a nuanced understanding of the policy wording and the ability to communicate complex terms in an accessible way, adhering to the principles of treating customers fairly. The correct approach involves proactively identifying potential gaps in the customer's understanding of accidental damage cover and offering clear, tailored explanations. This demonstrates a commitment to providing accurate and appropriate advice, aligning with regulatory expectations that insurers and their representatives must ensure customers understand their policies. By offering to review the policy and explain specific clauses, the advisor is fulfilling their duty to provide information that enables the customer to make informed decisions about their insurance needs, thereby treating them fairly. An incorrect approach that focuses solely on the customer's stated needs without exploring potential misunderstandings of accidental damage would be professionally unacceptable. This failure to probe deeper could lead to the customer believing they have cover they do not, resulting in a complaint or claim being declined. This would breach the duty to provide clear and fair information and could be seen as a failure to treat the customer fairly. Another incorrect approach, which is to simply refer the customer to the policy wording without further explanation, is also professionally deficient. While the policy document contains the contractual terms, it is often complex and difficult for a layperson to fully comprehend. Failing to offer assistance in interpreting these terms, especially when the customer expresses uncertainty, can lead to a lack of understanding and potentially unmet expectations, again contravening the principles of fair treatment. A further incorrect approach, such as assuming the customer has a comprehensive understanding of accidental damage simply because they have purchased household insurance, is a significant oversight. Insurance products are complex, and assumptions about customer knowledge can lead to misinterpretations and dissatisfaction. Professional decision-making in such situations requires a proactive, customer-centric approach. Advisors should actively seek to understand the customer's knowledge level, identify potential areas of confusion, and provide clear, concise explanations tailored to the individual's needs, always referencing the specific policy terms and conditions and relevant regulatory guidance on clear communication. Question 18. Market research demonstrates that consumers purchasing household insurance products are increasingly seeking clarity on policy terms and conditions. An insurance intermediary is preparing to provide pre-contractual information to a potential client. Which of the following best reflects the primary legislative framework governing the disclosure of information to this consumer in the UK? Option A. Prioritizing the terms and conditions stipulated in the intermediary's commercial agreements with their panel of insurers. Option B. Consulting only legislation predating the implementation of the Consumer Insurance, Disclosure and Representations Act 2012. Option C. Adhering strictly to the disclosure requirements outlined in the FCA Handbook, particularly the Conduct of Business Sourcebook, COBS. Option D. Relying solely on the principles of the Insurance Distribution Directive, CII, as published by the European Union. The correct answer is C. Adhering strictly to the disclosure requirements outlined in the FCA Handbook, particularly the Conduct of Business Sourcebook, COBS. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an insurance intermediary to navigate the complex and evolving landscape of consumer protection legislation, specifically within the UK's financial services sector, as it pertains to household insurance products. The challenge lies in accurately identifying and applying the most relevant legislation to a specific product disclosure scenario, ensuring compliance and protecting the consumer without overstepping regulatory boundaries or providing misleading information. The intermediary must demonstrate a thorough understanding of their disclosure obligations under the law. Correct approach analysis. The correct approach involves identifying and adhering to the disclosure requirements mandated by the Financial Conduct Authority, FCA Handbook, specifically the Conduct of Business Sourcebook, COBS. COBS sets out detailed rules on the information that must be provided to consumers before, during, and after the sale of financial products, including household insurance. This includes providing clear, fair, and not misleading information about the product, its terms, conditions, exclusions, and the intermediary's own services and remuneration. Adherence to COBS ensures that consumers can make informed decisions, which is a fundamental principle of consumer protection in the UK financial services market. Incorrect approach is analysis. An approach that focuses solely on the Insurance Distribution Directive (CII), without considering its implementation within the FCA Handbook, COBS, is incomplete. While the IDD sets overarching principles for insurance distribution, the FCA Handbook provides the specific, granular rules that UK firms must follow. Relying only on the directive's broad strokes risks missing crucial detail. An approach that prioritizes commercial agreements with insurers over statutory disclosure obligations is a significant regulatory and ethical failure. The intermediary's primary duty is to the consumer, as dictated by law, not to the commercial interests of their partners. Such an approach would likely breach FCA rules on treating customers fairly and could lead to significant enforcement action. An approach that relies on outdated legislation or guidance, such as Primi FID Roman II regulations, would be non-compliant. The regulatory environment is dynamic, and intermediaries must ensure they are operating under the current legal framework. Failure to do so means consumers are not being provided with the most up-to-date and relevant information, undermining informed decision-making. Professional reasoning. Professionals should adopt a systematic approach to regulatory compliance. This involves first identifying the specific regulatory body overseeing the product and market, in this case, the FCA for household insurance in the UK. Then, they must consult the relevant sections of the regulator's handbook, paying close attention to sourcebooks like COBs that govern conduct and disclosure. When faced with a disclosure requirement, the professional should ask, what does COBs require me to disclose to this customer about this product at this stage of the sales process? Cross-referencing with other relevant legislation, such as the Consumer Insurance, Disclosure and Representations, Act 2012, is also important, but the FCA handbook provides the day-to-day operational rules for intermediaries. Question 19. Risk assessment procedures indicate that an applicant for household insurance has provided details about their property that appear to be incomplete regarding the age of the roof and the presence of any specific security measures. Which of the following approaches best aligns with regulatory requirements for underwriting and risk assessment in the UK household insurance market? Option A. Focus on gathering further specific details about the roof's age and the types of security measures in place to accurately assess the property's risk profile, while ensuring the applicant is treated fairly and without discrimination. Option B. Automatically assume the roof is old and the security measures are inadequate, leading to a higher premium or potential decline of cover based on the perceived lack of detail. Option C. Investigate the applicant's general financial stability and employment history, as these factors might indirectly influence the perceived risk of the property. Option D. Decline the application immediately due to the initial lack of complete information, without attempting to obtain the missing details. The correct answer is A. Focus on gathering further specific details about the roof's age and the types of security measures in place to accurately assess the property's risk profile, while ensuring the applicant is treated fairly and without discrimination. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the insurer's need to accurately price risk with the regulatory obligation to treat customers fairly and avoid discrimination. The underwriter must interpret the information gathered during risk assessment not just for its financial implications, but also for its potential to lead to unfair outcomes for the applicant. The challenge lies in distinguishing between legitimate risk factors and those that could be considered discriminatory or irrelevant to the insurability of the household. Careful judgment is required to ensure that the underwriting decision is both commercially sound and ethically compliant with the principles of fair treatment and non-discrimination embedded within the regulatory framework. Correct approach analysis. The correct approach involves a thorough review of the applicant's declared information, cross-referencing it with available data and established underwriting guidelines to identify any material non-disclosure or misrepresentation that directly impacts the risk profile of the property. This approach is correct because it adheres to the fundamental principles of insurance underwriting, which are to assess risk accurately and price it appropriately. Crucially, it aligns with the regulatory framework's emphasis on transparency and fairness. By focusing on factors directly related to the physical condition, security, and occupancy of the property, the underwriter is acting within the bounds of acceptable risk assessment. This ensures that the premium reflects the actual risk presented by the property, rather than being influenced by irrelevant or potentially discriminatory factors. The regulatory framework for household insurance in the UK, as governed by bodies like the Financial Conduct Authority, FCA, mandates that insurers must act honestly, fairly, and professionally in accordance with the best interests of their customers. This means that underwriting decisions must be based on objective risk factors and not on assumptions or biases. Incorrect approach is analysis. An approach that focuses on the applicant's perceived lifestyle or social standing without a direct link to the property's risk is incorrect. This is because it introduces subjective and potentially discriminatory elements into the underwriting process, violating the principle of fair treatment and potentially breaching anti-discrimination legislation. Such an approach moves away from objective risk assessment towards profiling, which is not permissible. Another incorrect approach would be to automatically decline cover based on a single, minor discrepancy in the application without further investigation or consideration of mitigating factors. This fails to demonstrate due diligence and could lead to an unfair outcome for the customer, contravening the regulatory expectation that insurers should engage with customers and seek to understand their circumstances. Furthermore, an approach that relies solely on outdated or irrelevant risk factors, or fails to consider the specific context of the property and its location, would be professionally unacceptable. This demonstrates a lack of adherence to current underwriting best practices and regulatory guidance, which requires risk assessment to be current, relevant, and proportionate. Professional reasoning. Professionals should adopt a systematic and evidence-based approach to risk assessment. This involves 1. Understanding the applicant's declared information thoroughly. 2. Identifying all material facts that directly influence the risk of insuring the property, e.g., construction, security, occupancy, previous claims history. 3. Cross-referencing this information with internal underwriting guidelines and external data sources where appropriate. 4. Evaluating any discrepancies or potential non-disclosures in the context of their impact on the risk. 5. Making a decision based on objective risk factors, ensuring fairness and compliance with all relevant regulations and ethical standards. 6. Documenting the assessment process and the rationale for the decision clearly. If there is any doubt about the interpretation of information or its relevance to risk, professionals should seek guidance from senior colleagues or specialist departments. Question 20. The evaluation methodology shows that a household insurance claim has been submitted following a fire. During the claims investigation, it is discovered that the policyholder failed to disclose a previous, unrelated fire at the same property that occurred 5 years prior, which was not mentioned when the current policy was taken out. The policyholder states they forgot about the previous fire due to the trauma experienced at the time. The insurer is considering how to proceed with the claim. Which of the following approaches best reflects the application of insurance law principles in this scenario? Option A. Automatically reject the claim due to the non-disclosure of a previous fire, as this information would have been material to the underwriting decision. Option B. Investigate the materiality of the previous fire to the current risk, considering the policyholder's explanation for the non-disclosure, and apply the remedies available under the Insurance Act 2015 based on the findings. Option C. Offer a significantly reduced settlement amount to the policyholder, reflecting a penalty for the non-disclosure, irrespective of the detailed legal assessment of materiality. Option D. Accept the claim in full without further consideration, as the policyholder has provided a reason for the non-disclosure, and the previous fire is not directly related to the current incident. Correct answer is A. Automatically reject the claim due to the non-disclosure of a previous fire, as this information would have been material to the underwriting decision. Explanation. This scenario presents a professional challenge because it requires the insurance professional to navigate the complexities of insurance law, specifically concerning the duty of utmost good faith and the implications of non-disclosure or misrepresentation in a household insurance context. The challenge lies in accurately applying legal principles to a factual situation and determining the appropriate course of action, which has significant consequences for both the insurer and the policyholder. Careful judgment is required to ensure fairness, compliance with regulatory requirements, and the maintenance of professional integrity. The correct approach involves a thorough investigation into the circumstances of the claim, focusing on whether the non-disclosure or misrepresentation was material, and whether it would have influenced the insurer's decision to offer cover or the terms offered. This aligns with the principles of insurance law, particularly the Insurance Act 2015, UK, which governs non-disclosure and misrepresentation. The Act places a duty on the policyholder to disclose every material circumstance which is known or ought to be known by the policyholder, and to present every representation of fact in a manner that is reasonable. For insurers, the Act clarifies the remedies available for breach of this duty, depending on whether the breach was innocent, negligent, or deliberate. The correct approach would involve assessing the policyholder's intent and the impact of the non-disclosure on the risk assessment, leading to a proportionate response that is legally sound and ethically justifiable. An incorrect approach would be to automatically reject the claim solely based on the discovery of non-disclosure without further investigation. This fails to acknowledge the nuances of insurance law, particularly the concept of materiality and the different levels of culpability. Such an approach could breach the duty of utmost good faith owed by the insurer to the policyholder and potentially contravene the Insurance Act 2015 by not applying the correct legal tests for remedies. Another incorrect approach would be to accept the claim without any consideration of the non-disclosure, even if it was material and deliberate. This would undermine the principle of indemnity and could lead to adverse selection for the insurer, potentially impacting future premiums for other policyholders. It also fails to uphold the insurer's responsibility to ensure that policies are underwritten based on accurate information. A further incorrect approach would be to offer a significantly reduced settlement without a clear and justifiable basis derived from the legal assessment of the non-disclosure's materiality and the policyholder's culpability. This could be perceived as unfair and may not align with the remedies permitted under the Insurance Act 2015, potentially leading to disputes and regulatory scrutiny. The professional decision-making process for similar situations should involve a systematic approach. First, gather all relevant facts and documentation. Second, identify the applicable legal and regulatory framework, in this case, UK insurance law and the Insurance Act 2015. Third, assess the materiality and nature of any non-disclosure or misrepresentation. Fourth, determine the appropriate legal remedy based on the assessment. And fifth, communicate the decision clearly and transparently to the policyholder, providing justification for the outcome. This structured process ensures that decisions are informed, compliant, and fair.